All right, so Adam, thank you for being here with us. I don't think you need much of an introduction to this crowd. They know about your early days contributing to Bitcoin, Blockstream. More recently, you launched the BSDR, a new treasury company. But I think what some people might not know is how you're also quite a passionate trader, and have an intellectual curiosity into it. And I think it's very interesting to ask you some questions, not necessarily all about options, but really in terms of what requires you to think like an option trader, which is sort of non-linear yet systematic thinking. And I think your background both in engineering and then trading is interesting from that perspective. I would like to maybe start with maybe an anecdote to warm us up. I heard you mention this beautiful anecdote about the early predictions of 200 trillion market for Bitcoin by Hal Finney, which is a great sort of example of this nonlinear exponential style thinking. Maybe enlighten the crowd for what specifically he told you.
Yeah, so you can find this post. It was on the cryptography list that the Bitcoin network launch was posted about by Satoshi, and I think the sort of white paper kind of publication before that on that forum and a few others. So I think I'm not sure what the date was, like 9th of January 2009, something like that. So it's the first day of the Bitcoin network. He's received the first transaction, it's Hal Finney, from Satoshi, and then he starts musing about the addressable market, and he figures 200 trillion is a good addressable market, which he's just pulling from like cash and cash alternatives, bond markets, real estate, adding up loosely to a big number and dividing it by 20 million as an approximate number and saying, oh, it could be worth 10 million a coin. And it's just, you know, people are throwing out ambitious numbers these days, but he did it on the first day before, like years before there was a market price, before there were any users. I mean, there's probably a handful of people that installed the software at that point, right? And the hash rate was probably below 1 difficulty, actually. I think the blocks were running slow for the first year. So really out there thinking about potential addressable market, let's say.
Yeah. It's sort of interesting how, like, sometimes to see through uncertainty, you need to sort of think about like the extreme end games and outcomes that could be in front of you. And that's coincidentally also how like a lot of options traders think. They think a lot about like what are the extreme outcomes that you'd have and use that as inspiration for trades. Now, a big topic and of course a very important trends, one of the most important trends in Bitcoin is just that its volatility is really come down over the years. How have you experienced that as an early Bitcoin, and how do you project Bitcoin as an asset class? How do you project its volatility going forward in the next 3 to 5 years?
Well, I mean, it's, I guess, gradually coming down. Still can be volatile in the short term, relatively speaking. Probably the new types of buyers are affecting the market structure, and the option hedging that different parties do will flow through to the spot markets and the perpetual futures markets through arbitrage of the option closes and things like that. You do see some big option closes pulling the price around a bit, and the CME gap as well. Yeah. That's another nice one lately. So new factors. I mean, when I started in Bitcoin, I mean, like there was a great deal of risk perception because this was in 2013. And so, you know, there's this kind of concept people have that people were lucky if they were early, but most people who were early, you know, bought at, I don't know, $1,000 and sold at 1,200 or something, right? Yeah. and then regret it ever since or something. And Hendrik Ghys, who was the person who introduced Michael Saylor into Bitcoin, said he did something like that. You know, he sold Bitcoin and he figured he'd never be able to buy as much Bitcoin back, and because he took a profit, but he regretted that also. So I think you can look at the people who stayed the course in Bitcoin as a kind of survivors, people who are somehow psychologically sort of value investors, the stubborn types of people that would hold Amazon through a 90% drawdown and back out the other side and just keep, if they think it's valuable, they just keep buying. So I think there's some survivorship in that. Of course, some people, sold or regretted it and bought back at a higher price, and they're still here. But I think it's part of the price formation of Bitcoin effectively that you've got the halving phenomena where it's considered to be, a cycle driver, right? That there are half as many coins being produced in the next cycle. So there are less coins coming onto the market, and that percentage versus the total supply is shrinking. So some people would say that the halving should have logically little impact, at this stage. But I think what that overlooks is that as people experience the volatility, they either, leave because they applied leverage, or they took a profit too early and then don't want to buy back in, or whatever went wrong for them, or speculated with altcoins. That's a good way to get burnt in this space. And yet, so however the people that remained holding navigated that, they learned a lesson, or they were stubborn value investors to start with, you end up with, over time, more and more coins being taken off the market and cold stored. And so I think effectively the market effect of the halving is between, the coins that are tradable, buyable, on exchange, that kind of metric, versus the halving. And then both of those things are shrinking. And so I think that partly explains why the halving still seems to have a big impact. And, there were all kinds of different market structural effects rising over time. So in the kind of 2013 era, I was doing cross-exchange arbitrage, even just manually. There would be some exchanges that would be persistently 2 or 3, hundreds of basis points above other ones, and you could just, transfer money there, buy Bitcoin, move it somewhere else, sell it, wire it back, and do it again. And the wire transfers were really slow at that time because, they still are slow, but they were much worse because the banks didn't trust the exchanges, and I also didn't trust the exchange. So I was doing this initially on BTCE, which seemed to have a premium. So I would a discount rather. I would wire transfer money there and buy Bitcoin, transfer it to Bitstamp, sell it, and then wire it back and do it again. And the slowness of the wire transfers you could see, because if there's a market pullback, there was a demand to buy Bitcoin, but it couldn't move money quickly enough to actually do it. So you'd see the kind of 3-day delay, and then the wire transfers land, and the Bitcoin price would recover. So now, with the introduction of Tether, that of course improved, because Tether was initially a solution for the difficulty of exchanges having bank accounts where they could send and receive wires to users. And so there were a whole wave of exchanges that had no client-facing bank accounts, and it solved a problem. Of course, Tether's gone on to be used for other purposes now, but you can see that the efficiency of that arbitrage changed over time. And at some point, somebody started professionally market making BTCE to Bitstamp, and that spread, dropped from hundreds of basis points to not really worth it for manual arb. And so I moved to another arbitrage, which didn't work out so well, which was the Mt. Gox Bitstamp arbitrage. So when Mt. Gox kind of started looking shaky and they were saying confusing things about transaction malleability, I took coins that I bought there off, emptied the account actually, and then there's this huge arbitrage. Talking about 10%, and it would oscillate. So I took this 10% arbitrage 3 times, but unfortunately didn't take the money off, and so I'm sure I made money in dollar terms, and actually I'd intentionally only put on enough to be worth doing, but not so much, because I could see it as a risk premium that I would be, crying if I lost those coins. But it was remarkably fast that I lost the coins. There's a lesson there that never mistake risk premium for arbitrage opportunity.
Yeah, usually with those arbitrage, you're basically selling some kind of put, and if you don't know what it is, then sometimes real is a way to reveal itself.
Yep.
Let's maybe talk a little bit about some of the key drivers of the more muted volatility that we're seeing. And I think treasury companies have a very important role. I think they're definitely to the top side. They seem to be absorbing volatility. They're sort of, as an investment vehicle, you described it sort of this new alternative to get a form of derivative exposure to Bitcoin as underlying, in addition to options, in addition to levered ETFs. But like, say maybe a little bit more about how exactly you describe the sort of the payoff function of a treasury company.
Yeah, I mean, I think they've evolved over time. So I was a relatively early investor in MicroStrategy, and initially they had non-trivial amounts of leverage, actually. And so, one way to look at buying MicroStrategy in that phase is you were outsourcing leverage management to MicroStrategy. And of course, a public company actually has some advantages because in a pinch, they can always raise money by selling shares in the market, maybe dilutively, but they can also benefit from the upside of having this kind of somewhat relaxed leverage regime. And they were also effectively able to use their equity as a collateral for it. So their margin was not a direct lien, it wasn't directly liquidatable. Now, if you go back and plot their first 18 months or something into a leverage ratio, you could see that for 5 months they were over leveraged. Like their debt was actually higher than the Bitcoin NAV, which if that was an exchange account would have been liquidated. So that was kind of high leverage. But there was no direct lien. They kept paying the interest. They had revenue from the operating business, and there was an equity cushion under it. So they were still solvent in that sense. And I guess there was just no combined interest from investors or bond lenders to try to call that or to stage a investor revolt or something like that. So they got through it, and indeed that that high leverage became part of their fast start because they profited it quite highly from that in their initial period. But the MicroStrategy team is they're learning from different types of assets. They've explained their thought process as they move from bonds to convertible notes to at the market share selling to now the different versions of preferred stock. So really a lot of those things are some form of leverage with some different trade-offs. And there have been some even interesting Bitcoin basis convertibles recently from H100. I think Sander was in the room somewhere. And also from Capital B, a French treasury company, where they are raising money using a convertible note. The investor is lending the company Bitcoin. If at maturity it fails to achieve a conversion premium, you get the Bitcoin back. They're storing it in a custodian. So unlike a dollar debt, there's not really a kind of liquidation risk because they have a Bitcoin debt and a Bitcoin collateral for it, and the interest rate is zero as well, so they don't have any interest cost. And if it captures a conversion premium, people have the right to convert it and convert that into shares, sell the shares, or hold them. So I think that's one factor, and of course the treasury companies are sort of active. It's not like an ETF or a spot or a physical Bitcoin position. They're actively managing the Bitcoin using capital markets, raising strategies to increase the Bitcoin per share. But of course, there's always a risk-reward trade-off. One of the risks you're taking is buying it at a high MNAV and have the MNAV fall. But I think generally the way I looked at that is if you can build a position and achieve a starting point where your personal acquisition cost is a 1 MNAV, i.e. that you paid 1 Bitcoin for a number of shares that contain 1 Bitcoin. And generally speaking, they should be able to maintain that, in my view, if they are not, over leveraged or something.
Yeah. Yeah, it sounds like there is a bit of an analogy there with options where you pay a premium to be long gamma, and then the option sort of decays. So really the bet is on the market moving enough to offset the decay. And so if you buy a treasury company at a premium to NAV, you're sort of making a bet on their accumulation of Bitcoin per share being fast enough to sort of justify that premium, and at some point the price where you entered now becomes actually the level where the Bitcoin NAV sits as it accumulates.
Yeah, and I mean, some of the treasury companies are sort of making the Bitcoin they have work for them. That's something that BSTR have communicated that we intend to do once we're through the regulatory approval stage. And it's something that Metaplanet has been doing. They've been selling put options where they get the put premium. If the strike is not hit, if the strike is hit, well, they buy the Bitcoin at a cheap price, so they don't mind. And as I understand it, they're also a bit sort of adaptive to the market, so they will potentially borrow money from Evo Fund, who is doing their moving strike warrant, so a ATM-like facility. If Evo believes they have the capacity to raise that in the future, and they see a market opportunity now, so they have a bit of flexibility from the public market, from their moving strike warrant, like fund management partner. And you know, I'd say some of these treasury companies have been actually remarkably effective at growing Bitcoin per share in a compressed period of time. You know, Metaplanet, it hasn't been many years in operation, and you know they've already grown quite, you know, appreciably, and the same with, you know, some of the European ones, like Capital B and H100. They've grown in a short period of time. But of course, it's, you know, it's volatile, and some of the MNAVs have oscillated a great deal during their period of operation.
Yeah. And I think then, like, the impact they're having on the market, I think it's straightforward to think that they increase the drift of Bitcoin and absorb volatility on the upside, because they're very willing buyers at peaks. But I think a lot of the fear in the market and uncertainty around treasury companies is how they will withstand, for instance, bear markets and MNAV compressions. So what's your model actually there to think about whether like 1x MNAV is actually sort of acting like a floor I mean, it's clear with the over-levered ones that it can't, but some of the larger ones, right, like the Metaplanets, the strategies, who also have the biggest market impact potentially, like how should we think about like the 1x MNAV border?
Well, I mean, I think Metaplanet has a very low debt ratio, and MicroStrategy also at this point, you know, they had that high debt ratio in their first bear market, the only one that's really been through a full bear market. But they are communicating a much lower intended debt ratio. I think they're targeting 30%, and their debt ratio is actually lower. And they seem to be intent on phasing out the convertible notes, which is the notional debt they have, and replacing it with the preferreds, which are generally not repayable. They're not formally debts, right? Because they're perpetual preferreds. And so then the risk is just, you know, can they continue to service the debt? But they try to have a great deal of over collateral in Bitcoin terms. So I think generally, you know, if you look at the type of investor you could have in a public company, people will talk about a good investor as a believer in the long-term value of the company, a value investor that buys, and if the price falls, they're happy to buy more, right? And you know, from that point of view, treasury companies are good investors. They buy. They have a stated objective of not selling, typically. They certainly want to increase their Bitcoin per share. Now, I think in terms of the one MNAV kind of supportability as a floor, a simple strategy they can do if they can raise money using preferreds is to buy back their own shares if they're below 1 times MNAV. If they don't have a preferred-like facility, of course, they can't sell shares because that would go against them, but they could incrementally sell Bitcoin, buy back their shares, and increase Bitcoin per share in that way. So from that point of view, I think the opposite of the ATM is to sell Bitcoin and buy back shares, and that means they can profit in either condition as long as they, you know, keep their debt ratio in check. And most of them have, you know, articulated relatively conservative things about debt ratios. The Bitcoin basis converts are actually quite resilient to market conditions because, you know, if Bitcoin price falls in half, their debt ratio is completely unchanged. And actually some of them were able to start with extremely high levels of leverage, which would be quite unwise if it was euros or krona, but be completely unaffected by liquidation risk because of the debt being the same currency, basically.
Yeah. If you then take a little bit of a step back and think about the market infrastructure that these companies are operating in, I think a lot of it right now is focused on sort of the fiat to crypto arbitrage, the TradFi to crypto arbitrage. I think you have more sort of focused on a mission to create these more Bitcoin native capital markets. Maybe first zoom in a little bit of linking back to some of the panel discussions before about how clearly exchanges and market infrastructure in crypto is still a big source of volatility and left tail risk. So sort of to situate the issues that we still see today, but then also look forward to your vision for more Bitcoin native capital markets.
Yeah, I mean, I think the perpetual futures infrastructure and even spot and just the index prices have evolved gradually for the better, but it's still not great. I think one of the structural problems for Bitcoin is that most of the investors are value investors, but they end up all in. So when they see a buying opportunity, they don't necessarily have the firepower to buy more. And so that tends to mean that Bitcoin is a little weak to the downside. So it's easy for somebody to shock it, to open a short position, do a market sell, and then buy it back more slowly. So you see, or some trigger event, like a liquidation cascade in something, or some, weekend geopolitical comment from a few weeks ago. So that's one factor, and then I think you've got markets are not always continuous in the sense that the price is not. You can have liquidity dry up, and the pricing across exchanges is not always very tightly correlated, so some of the market making is not as good as it could be. And so historically there have been cases where the price on one exchange is $1,000 below on another exchange or something, or even 2,000, and so there would be people that would then get angry and threaten the exchange that they got liquidated unreasonably, and they would be using a local exchange mark price for the perpetual futures or the leverage, and so over time they've come to use a basket of reference prices from different exchanges as the mark price for the perpetual futures, and that helps. And then sometimes they would sort of remove the outlier. So if one exchange was way too high or way too low, they just remove it from the index. I think that was even an issue, just in the last month. I think Coinbase printed a bad price for something unrelated, like a bad price for a stable coin that was very far away from 100, which is basically a defect. And that actually, flowed into some of these price calculations for Bitcoin against a mispriced stablecoin, and triggered some liquidations, which that this kind of thing shouldn't be happening anymore. So, of course, they took defensive action and fixed it afterwards. But I do think the crypto exchanges have to get more serious, because Wall Street is in play now, and BlackRock will switch away from Coinbase if Coinbase doesn't stop crashing under load or printing bad prices and things like that. Any serious player doesn't want an exchange where they can't trade when they really need to, or the order book fails, or they're printing bad price information, all these kinds of things. So a serious stock market doesn't do that, because they've got more institutional grade order books and much better market making. So I think there is some kind of value investor type of market making going on at Bitcoin, where people will systematically buy up Bitcoin in dips, in the kind of few months kind of time frame, and that's good. But it could probably do with more of that, and maybe we'll see more of that into the future as the volatility comes off. It becomes more reasonable to do. I think a previous topic was why is the why doesn't the efficient market smooth out the start of the cycle after a halving? And I think it's just because of the volatility. It's very hard for the average person who's not like got a Bitcoin native position that they're trading with to want to take that arbitrage, basically.
Yeah. But then if we don't get our act together, basically the risk is that like all this institutional attention that we now see, that it's just going to drive into CME clear contracts. So what's the path that we can actually ultimately get the institutions really on some more crypto native infrastructure?
Yeah, I mean, I think it's ours to lose, so we should, a bit. The Bitcoin exchanges have had, a decade head start, so it'd be kind of sad to lose the lead at this point, right? But then some of the traditional markets like CME, SIBO, Nasdaq, these kind of markets have a lot of liquidity, better banking rails, and they look like a low-risk option. They have good custodians that they rely on that are very highly trusted. So I think you're seeing some things that shift at the moment post FTX, that the use of custodians as a holder of the assets that are being traded is that's how things have worked in traditional markets, reactive to previous issues for consumer protection reasons. And so the more institutional or bigger traders are starting to demand that from exchanges, and there is a rise of this trilateral agreement type of arrangement. So Blockstream Capital Partners made investment in Kainu, which is one such entity that is providing institutional grade custody for actually the UK government and other kind of institutional players. And then they work with exchanges to have the custody of the coins on the custodian and just pledge those to the exchange as an IOU to trade with. And that, that provides better protection for the user in the event that, there's an insolvency event with the exchange. So, hopefully there aren't any more exchanges in that position, but people have, they've taken the FTX lesson where they got over the Mt. Gox lesson and went through a few more failures.
Yeah, but I sometimes feel though that we learn one lesson and then we unlearn another. I think from what I'm seeing in the exchange space is, yes, after FTX, there was more focus on third-party custody or self-custody, but in terms of market risk, what also blew up is this prime brokerage function, right? Where there was just excessive leverage. 3AC was a great example where there was just no background checks, no monitoring of positions across exchanges. But then actually what happened is that market sort of disappeared to a large extent, and the exchanges, who are kind of implicitly with their insurance funds, their own clearinghouses, they also became sort of prime brokers. And now every exchange is offering like a lot of leverage to market makers. And so you have, the good thing is I guess that volatility in Bitcoin is declining, because if we would have like a 30-40% market shock, and the market makers are supposed to provide the liquidity, are basically margin called, then there's a lot of systemic risk embedded. And I think it's the lack of a clearing function. And so maybe we need to think about that.
Yeah, I guess so. I think, you mentioned the 3 Ares Capital, and I think, ultimately the problem there was, unsecured lending, right?
Yeah.
So somehow a lot of people got persuaded to provide free, uncollateralized or under-collateralized leveraged 3 Ares Capital, who were, taking an arbitrage while it existed before it went into reversal. And then, of course, they got heavily liquidated and caused a string of bankruptcies and liquidation issues in a sort of contagion through the system. And there were unfortunately some entities that were largely innocent or didn't understand the amount of risk that was piled up behind that, because there'd be intermediaries that would sell it as like lower risk than it was, and so they didn't realize under collateralized return. So I think the main thing is for the market to learn and adapt, right? But I think the other thing that you can do about this is to try to trade with full collateral. So if you're doing some kind of non-custodial trade, so there's some on Liquid, which is layer 2 Blockstream develops. There are some markets that have, atomic trades. You can place the trades from a hardware wallet even. You can get a web interface. You can set a limit order. You can sign it. There's not really a way for that to come unstuck. And, in the same kind of technology, it's possible to do covered call options and to have, if you want leverage on the covered calls, to have third parties who are collecting the interest on the collateral in a low-risk way. So it's actually a three-party contract. Somebody that sold the option, somebody that bought the option, and somebody that's providing the liquidity for the leverage in it, who's receiving an interest rate on it in a relatively low-risk way because it's all governed by high-assurance smart contracts. So I think there are mechanisms there. So either third-party custody and trilateral agreements, or trading in a way where you're not giving up custody. There's some types of trades you can do, some types of return you can get without giving up custody to third parties. Yeah,
and that then effectively kind of decentralizes the clearing risk that's now concentrated in these exchanges and sort of allows it to essentially disseminate. So maybe then to wrap up, I think the people that were sort of early to Bitcoin and sort of withstood the volatility, I think a lot of them sort of saw it as a way where they allocated probably the amount of capital they could lose, and they sort of saw it as an option where it could go to zero, but it could go like so much higher if the thesis was correct. And so if we do sort of now a Bayesian update, so many years later, given all the progress was made, and for instance, the regulatory uncertainty on Bitcoin is greatly reduced. You see, I think, with ETFs, with treasury companies, you now see career risk, I think, also starting to shift towards you have to be in Bitcoin rather than the risk was more on being an early adopter. So that's a fundamental shift. So if we take all these developments into account, like how do we think about like that same sort of asymmetry idea, but where maybe the floor on Bitcoin is now like a lot higher than it used to be?
Well, I mean, there is a nice metric, the 200-week moving average, a 4-year average, and that has been an up-only metric. I mean, you can't buy it because it's impossible to, I think, construct like even a perpetual on that. But it's generally been something where the price has very rarely gone below it, and that's currently around 54,000. Okay. So it's been increasing every 3 or 4 weeks by another 1,000. So it's an interesting way to look at volatility. If you think about the conservative floor value as a 200-week moving average, then and everything above that as froth of volatility, then you won't be disappointed, right? Don't get too attached to the kind of volatile overshoot, maybe. And I think it shouldn't be underestimated the degree it makes a difference to traditional finance that they now have Morgan Stanley, making a recommendation for model portfolios, BlackRock before them. So more major financial firms taking a position of recommending Bitcoin in a portfolio construction. I think that makes a difference. Some of the option volume probably will appear in the IBIT options. And you have now also option volatility ETFs that are, there's a couple on MicroStrategy, iMist, and MSTY that are, the structure is they hold US Treasuries plus some long and short options. If they make a win on their options, they'll pay out as a dividend approximately once a month. And if they have a miss, they will just deplete their capital a little bit. So you can't really think of them as a MicroStrategy plus yield. It's more like a dollar yield strategy, and it is depleting the capital. So while the notional return is over 100%, you'd have to offset that by how much the capital was drawn down. And then they have another one, which is Winter, WNTR, which is the bear market version, because they'll change the option strategy so you can kind of switch. And BlackRock has now very recently brought to market a Bitcoin version of that. And there were other Bitcoin ones, but this is the first BlackRock one. So this is actually more structural, professionally managed option demand for the option market. I presume, through the TradFi rails, but it's all arbitrage, right? So I think there'll be, opportunity for, Bitcoin firms to make structured products around those as well, because the ETFs can be tax inefficient. Like if you're a European resident and you buy those US ETFs, you get a 15% withholding tax that you have no way to claim back. So that's a kind of drag. So you have a European provider. I'm quite a fan of seeing, so I think there's some advantages that Bitcoin and derivative exchanges have over the TradFi, which is 24/7 markets. Bitcoin never sleeps. Bitcoin pricing. So historically, the long tail of altcoins, which I'm not a fan of, were initially priced in Bitcoin. Now you have treasury companies. So there are some of those that have been tokenized with a proper security mechanism. So it has an ISIN. It's a Luxembourg securitization fund, and it has 100 shares of MicroStrategy per unit. There's MicroStrategy, there's MetaPlanet, and there's some more in the works. And those have 24/7 pricing, and they're priced in Bitcoin, which actually is a more interesting pair for, it's a Bitcoin-basis swing trade, effectively. So I think those types of instruments would be quite interesting for the derivatives exchanges that also have securities licenses. And Bitfinex was one of the first into that, early exchanges to sort of dive into the security token market. And, there's now some more like Gemini, Kraken, Coinbase, they're all trying to do that. Typically, I think those US headquartered exchanges have kind of offered it offshore only or something like that. But it is a new area, and I think it's probably, more of a growth area and more of a interesting trade, at least for the Bitcoin investor, because there are a number of benefits to a treasury company, which is as compared to speculating on meme coins, basically, right? Which I'm not interested in. But I mean, even for somebody who has a neutral perspective, there are audited accounts, there are public market protections. Using those audited accounts, you've got the hard asset Bitcoin inside the company. Using the metrics, you can calculate and compare and make investment decisions based on actual data. So I think if those can get listed onto the securities exchanges, and then they can provide the 24/7 liquidity, the low-cost margin that derivatives exchanges are providing in terms of margin lending for margin trading, or even perpetual futures in these, or trades where the leverage is provided by Bitcoin. So if you think about it, because it's a Bitcoin-basis trade, if you were to say MicroStrategy is looking cheap in MNAV right now, you'll sell a bit of Bitcoin, buy a bit of MicroStrategy, wait for that to recover, hopefully, and then sell it back and buy back Bitcoin at a higher price and end up with slightly more Bitcoin. So if you like that trade and you have confidence it won't fall much below 1 MNAV, because the company would defensively protect that and profit from doing so, then you could, the leveraged version of that trade is actually not to use, Tether or dollar margin lending, it's to actually borrow Bitcoin, sell the Bitcoin to buy more. So that's the kind of, because your new trading pair in these type of trades is Bitcoin, the native leverage is actually Bitcoin leverage, which provides a kind of low risk Bitcoin yield actually for somebody who doesn't take a position in that but is willing to lend to it, where the margin risk is managed by an exchange. So I think that's an interesting direction for the derivatives exchanges to do. And then you also see people trading, so there's built on Liquid is a SideSwap, which is a kind of non-custodial trading platform. So they're trading the tokenized treasury stocks for Bitcoin in a sort of non-custodial way. And some of those trades, some of the trade demand is actually to swing trade, to bypass Bitcoin. So it's basically you trade MicroStrategy for MetaPlanet directly. So they're just trying to sort of time the MNAVs to increase their exposure of whichever one they prefer by kind of switching backwards and forwards tactically. So it's kind of interesting to see the shift historically from everything in the crypto space being priced in Bitcoin, introduction of Tether, and then dollars, euros, so priced in dollars, Bitcoin and the other things, and then now priced in Bitcoin for the treasury companies because they are effectively derivatives in Bitcoin. Yeah. And like with Deribit, right? The pricing is actually Bitcoin collateral, Bitcoin priced derivatives. So it's sort of logical to see that, and then you could also be interesting to see some of the sort of non-custodial derivative or custodial derivatives for options on top of these treasury companies between MicroStrategy and Bitcoin, but Bitcoin priced derivatives on different strike prices of MicroStrategy priced in Bitcoin. So I think there's lots of growth opportunity there, and I find that market. I mean, of course, anything about Bitcoin, like Bitcoin derivatives, Bitcoin perpetual futures, that's interesting for price discovery. But for price discovery of treasury stocks, I like to see those same kind of trading tools, the derivatives, the options, the perpetuals, with Bitcoin pricing and Bitcoin collateral as a potential growth opportunity here.
Yeah, sounds like tons of ways in which like the role of altcoins as sort of delivering higher beta Bitcoin can actually be moving there, at least for the rational investors among the lot.
Yeah, well, I mean, I think that's true, and the Bitcoin market share has been growing, I think, because the new investors that have come in this cycle have been, for the BlackRock ETF, it's about 2/3 retail, so just individual investors reallocating in a share portfolio, about 1/3 institutional, and the institutions that have come in, like the Swiss National Bank, some of the Abu Dhabi sovereign wealth funds, some of the pension funds, some of the US states, all of this kind of investment is, it's value investment, it's digital gold investment. They're really not interested in meme coin speculation.
Yeah, great. So let's open it up for questions.
Hi Adam, nice to meet you. Kudos for creating the fundamentals for Bitcoin, basically like Hashcat. But let's say it was 2018, emails with Satoshi, then 2019 Bitcoin launch. Like you went into the space in 2013. How did you deal with your own feeling that these 4 years were, absent, and about that at the time that there was something about Bitcoin? It was like, hey, I'm making Bitcoin based on your hashcat. And then 4 years later, you're into the scene. Your internal feeling, how did you manage to get over it? Because for my personally, it's way worse than like feeling about that, holding the Bitcoin through all these times, way more harder than to deal with actually, I knew one of the first about Bitcoin and actually came 4 years later, sorry for honesty.
Yeah, I mean, I was completely calm, and that's because I was, a value investor years before, and that there's no point crying about could have or should have. Everybody could be a billionaire if they could have done something in the past. So your perspective is just that you made a trade with the information you had at the time. If you think with analysis that you made a non-optimal trade, you should try to learn from that for the future. But there's really no point, being upset about what could have been, basically. And
yeah,
I think,
but it's not even about the money case. Like it's about, you're co-creating today the philosophy and way where Bitcoin goes, right? Let's say Roger Ver and like the war, it was so absurd. But so let's say, obviously you're not Satoshi. Who should I ask? Why it's not 9 minutes, 15 minutes, but 10 minutes block time?
So I think some of those things could be different. I think it would still work with some parameters different, but a lot of parameters are, if you try the experiment of changing them and thinking about what's going to happen, it doesn't work anymore, or it starts to work worse. So you can analyze some of those things, sort of. But I think Satoshi didn't really explain a lot of things about the design of Bitcoin. It's like, here's the source code, and the paper, if you read it, doesn't really explain why, mostly, right? It's just here it is, and here how it works. And then you have the source code, and then people try and figure out, well, is there a better design? And surprisingly, it seems not really. because people's intuition is valid that, you know, the first automobile, the first aircraft was very basic, and the technology improved. The first computer was very basic, and so you would think that, you know, the first Bitcoin, you could vastly improve it, but it doesn't seem to be the case. I think it's sort of a more physical, basic mechanism. You know, digital gold, right? I mean, gold hasn't changed in forever, right? And it still does the job 6,000 years later. So I think it's like that with Bitcoin. It's doing something very industrial, very basic. It's providing a digital version of scarcity of gold, and that's it. That's all it needs to do, really. I mean, plus, you know, improve the technical aspect, right? That the software gets a bit faster to cope with more users and things like that.
So changes are possible, generally saying.
Yeah.
Okay, so last one thing. Let's say Halfine is the one, and there will be a solution to like revive him from the cryogenic that he's, let's say, in 2150. Will that mean that this is the best holding strategy to freeze ourselves?
Well, I don't know. I mean, he was one of the people that was. So Halfine, if people don't know, was somebody interested in cryogenics. So he developed ALS, which is a life-threatening disease, and elected to be frozen in the cryogenic thing, right? So I'm not sure if he's going to get revived, but yeah, I mean, I guess it's a way to preserve value for the far future, right? At least Bitcoin is something like, I mean, gold has had a very surprisingly good track record for, you know, a certain amount of gold being able to buy a house or a horse or something across like 1,000 years, which is crazy, actually. So we'll see how Bitcoin evolves. But at the moment, Bitcoin's growing much faster because it's still early. It's still not got very much adoption. So I think that's part of what makes it interesting, because it has a kind of startup adoption overlay, right? But I think even once Bitcoin is fully adopted, it's still interesting to hold it because it's scarce, right? And nothing else around us is. So if you're able to hold Bitcoin as a kind of fractional claim on the world's spending power, that's useful to preserve the spending power.
Hi, I have a very basic question. Do you have any prediction or conviction, like where Bitcoin will go in terms of value or price in the next 5 years? Something like the 21 million in 21 years of Michael Saylor. But maybe not in 21 years, but in the next 5 years.
Yeah, I mean, it's difficult to project the time frame and the levels, but I think, you know, Halfine's projection doesn't seem, you know, it's starting to look more plausible now than it did when he gave it, because there was no users and no price and no network. But it's, you know, I think the interesting like first target I like is parity with gold. Now, of course, gold is, you know, at an all-time high now, but you know, Bitcoin's pretty high too. So I think it's parity with gold. At this gold price would be in the region of 1.2 million a coin, and maybe if Bitcoin started to get a bit closer to that, some people would reallocate from gold to Bitcoin, just you know, reactively. So it might need to get to that price because, you know, people selling gold to buy Bitcoin might pull gold down. And another interesting data point is a lot smaller percentage of gold is in ETFs. So the gold ETF market is not as big as you'd think it is. It should be, given the market cap of gold. So, you know, maybe that makes the market smaller and more susceptible to price influence from outflows. I think there may even have been some indication, because you can look at the gold. You know, people were avidly watching the inflow on the US spot ETFs. You know, how many million, how many billion a peak per day, and since inception. And there were also people looking at gold outflows and trying to see if there's a correlation. I think there probably was already a little bit of gold ETF outflow into Bitcoin, like earlier on in the spot ETF launch.
Thank you. Just a quick follow-up. How many people do you think that at the moment are like buying Bitcoin, maybe retail or even corporate, thinking about an alternative to gold? So,
yeah, I mean, I guess it's you know, you've got two two reasons to buy, and one is the adoption curve. So like betting on the internet, if you see lots of people are using it and it's growing and there's not many people using it yet. And the other one is the further future, once it reaches saturation and it presumably becomes more price stable. So probably a lot of the buying is going to be looking for the adoption curve, because that's the bigger factor at the moment, right? But so I think, some people will say that Bitcoin is a nascent store of value because it's still volatile, it's still growing, and eventually, presumably, it will become more stable. I mean, gold has been somewhat volatile in this year, right? But nothing like Bitcoin, of course.
Thank you.
Thank you. Thank you both for your time. Adam, I was just wondering, at this point in Bitcoin's evolution, what do you think the biggest threat is to us moving forward?
I mean, I think a lot of the regulatory risks have receded. So when Blockstream started in 2014, we were a little bit worried about, whether the US or Europe or Canada or several major economic blocs might simultaneously decide they really didn't like Bitcoin. And thankfully that hasn't happened. Some countries have sort of temporarily banned different aspects of Bitcoin, like the China mining ban. So I think the regulatory risk seems to have been navigated quite well. And I was also a little wondering what would happen when sovereign entities got involved in Bitcoin. If the incentive structure that makes Bitcoin work, that miners are mining Bitcoin, they're working in industry, to raise capital, they'll build power infrastructure, they'll buy miners. Whether as government entities got involved, if they would distort the incentives in a risky way. But so far it seems that the incentives have scaled, and it seems to have kind of, you see people in government positions that seem to understand and like Bitcoin for what it is, rather than coming in from a position of establishment power and influence, try to change or overlay their beliefs on Bitcoin. They seem to have accepted Bitcoin for what it is, a political international money. So that's been positive. I think the quantum, another thing people like to talk about is the quantum threat. I don't think it's really a threat. I think it's much further off than people think it is. Technologically, I think there's a bias of the people doing the R&D to want to market, their startups, to raise capital to do more blue sky. And in any case, there are available new signature schemes that work, that remain secure, so we can, they can be adopted by Bitcoin, and people can, gradually move their coins over to new signature schemes. Not too worried about that. I think it's actually, I think that Bitcoin ultimately needs to ossify, which means to start having less frequency of changes in the protocol. I think that, as it gets more valuable, that gets more risky and harder to achieve. So I think it's important that Bitcoin finalize the layer 1 so that other, experiments and new things happen on layer 2. Most networks are like that. The GSM networks, the internet itself, it's all in layers. So on the internet, you've got the physical layer, then you've got TCP/IP, and all the other things are above that. Web browsing protocols, email protocols, voice over IP, video streaming, all this stuff is happening at a higher level. And it's a little harder in Bitcoin because the base layer is providing security, and it turns out to be a little hard to transfer the security to the higher level. But that's, it's an active area of research. So hopefully we can get there in the next 5 years or something.
What about the energy consumption argument?
So I'll repeat the question, energy assumption argument. So I think it's, some people are concerned about energy consumption, but I think it's, like the analogy with gold is that I'd say that any hard money, like precious metal money, gold, silver, things like that, are used because they're scarce, and then they basically logically have to have a production cost, or they wouldn't be scarce. And so even though Bitcoin is digital, you can transfer it digitally, it's still a physically scarce thing. The physical scarcity comes from the industrial mining process. So I think it's sort of inherent that there has to be a production cost. And, you know, while that energy could be used for something else, having dependable money is extremely valuable for the economy, ultimately. So I think it's, you know, a worthwhile power spend. And also, you know, Bitcoin is effectively financing power infrastructure. And as we see from the AI and previous technology waves, the future is always demanding more power as we automate more things. And the countries that have the best power infrastructure, the most power per, you know, most megawatt per population, are the most prosperous. And that's been the case for hundreds of years. So I think that, you know, actually Bitcoin could help you. And anyway, we need to build the power for the future. So I don't really, you know, see a problem there. And, you know, of course, because of the halving, there are less Bitcoins to mine over time. So, you know, most of the coins have been mined at a far cheaper power expenditure, actually. You know, I mean, you know, 95% of the coins are mined or something like that at this point, right?
Maybe last question. We know from the debates about 1 month after the launch of Bitcoin that while Satoshi was pretty good about the game theory of the various parties participating in the ecosystem, he seemed to assume that only central banks can provide the elasticity which is required so that Bitcoin can stabilize and become a money proper for the real economy. What's your position today on that?
Yeah, I mean, Bitcoin is a completely inelastic money at its base layer, but you are seeing and one common sort of debate in the Bitcoin markets is the degree to which paper Bitcoin exists, like rehypothecation. And of course, that's a common, for anybody who's invested in gold, that's a common complaint, right? That some of the gold ETFs are not based on physical gold, they're based on mining stocks, or they're synthetic, or they lent the gold out multiple times and stuff like that. And so I think actually in today's Bitcoin market structure, there's relatively little paper Bitcoin, but one area which may be a little bit like paper Bitcoin is actually the treasury stocks, because people are buying treasury stocks at, you know, an MNAV above 1. And if that is, you know, some of them are buying treasury stocks who wouldn't have bought Bitcoin for various reasons, like regulatory reasons, or, you know, they found it easier to think about stocks than physical Bitcoin. But to that extent, there is some elasticity in the market price of the treasury stocks indirectly, right?